Okay, yeah. So private equity. Okay. So to do the job in a private equity business, it's not a difficult. Okay, but the difficult. Why it feels difficult? Because of concepts, because of terms, because of language, because of other technical terms which we are not aware about it, and just because that it feels like to do work with fund to work with private equity fund accounting is a difficult one. So as I earlier also mentioned in first session, if you are looking for a job in a fund accounting business, so you should have a good grip on accounting skills, basic accounting skills, golden rules of accounting, assets, liabilities, expenses, loss, right? Other important things, the accounting cycle from accounting, recording of accounting entries in the books of account till the preparation of final accounting for a particular business, maybe for a particular fund. So you should know that in details. And if you don't know, then trust me, will be very tough for you to get into it or to even to serve in a private equity business as well. And one more request I would like to do, start to do preparation of accounting entries right away, start to do preparation of final accounting and all. So you can refer 11th and 12th standard accounting book, or else you can refer the CA's book as well if you want for accounting. Do read concept, do practice, pick up problems and do practice, maybe for a partnership accounting, maybe for a private company accounting, public company accounting and all, or maybe any company's accounting. So you can refer the accounting books and do the practice. Let me know if you don't have a books, but if you don't have a time, then it would be tough for you. Okay. So in accounting, final, definitely you can see the chapter which is final accounting. In that you can see the chapter which is, or maybe the types of final accounting for a partnership firm. So definitely you would see the problem or maybe term, so that you need to go through it. Okay, private equity accounting works similar like a partnership accounting. Okay. Anyways, do right away. Yes, do right away after this call. Okay, and then start to work on it. The few terms you may definitely see in a private equity business, which is total commitment, funded amount, unfunded amount, pay down, drawn down, delayed drawn, principal reductions, pay downs, clawback, dry powder, and many more. Even though catch up, carried interest, management fees, and different other expenditures. Okay, but the important is you should know that the meanings of all the concepts, and that's what we're going to cover, that all important terms here in this session, how it's work, and also we'll try to cover the accounting entries for a different things. But let me tell you something. So do you know about how the funds work? Fund cycle. Fund cycle. Are you aware about it? To launch scheme, to raise the fund, you may call subscription, to invest in equity, maybe preference stock, right? Maybe fixed income instruments, bonds, loans, debentures, money market instruments, and etc. To generate returns in terms of dividend, interest payment, dividend which is fixed and floating in the sense flexible, I would say, or which is not fixed. Basically that will be with the common equity and fixed would be with the preference equity. Interest payment floating or fixed and floating. Right? And capital gain and loss even. Then to charge the fees. Why to charge the fees? Any idea? Exactly, to charge the fees. Could be management, admin, miscellaneous, custodian, broker, agent, meeting, conference, or other partnership expenses. Few expenses will be shared and few will be individual. That depends. But in a partnership accounting, let's say you and I both are the partners. In that case, will record the both the means contribution for both, and will also record the expenses and income to the partnership accounting, and that will allocate to both the means your account as well as my account also, to know the exact value of my account or my investment, and same applies to you as well, to know the exact value of your investment also. Okay. Generate return. Okay. Then now you raise, you launch, you raise, you invest, then you get something, right? Even though you charge fees and all, but what about to return the capital to the investor back? So it means to return the capital. To return the capital, and return the capital, it means to redemption process, right? And finally that the account will be closed out, or in the sense close out, I would say, for that particular at least situation, means that this is how your fund life cycle works. And again you can launch the scheme, raise the fund, invest, generate some return, and return capital with, return the capital with redemption process, return the capital with committed return. Any doubts so far? Any doubt? You may expect, definitely you may expect question on how the cycle works. This is the cycle which you can see in a fund business. To launch, to more differences. Wait a minute, don't go on that. This is like a generic structure. Okay? This is like generic structure which can apply to all the fund businesses. They launch the scheme, they raise the capital, they invest, then generate the return, right? Then they manage the asset, they charge the fees, and then after they return the capital. But in between you can see the different processes. If you take the example of private equity business, they majorly invest into illiquid assets. Private equity investment instruments, preference equity, right? Bonds, ABS, MBS, preference equity, bonds, ABS, MBS, loans, or any other way they can find, or they can sign the agreement with the particular investment company. That depends. And when you say preference equity, you may expect dividend, which is fixed. Bonds, interest payment. Also interest payment. For a bond, you can say coupon, but yeah, eventually that is a interest payment. And this all comes under the, see, if the fund invest in a preference equity, bonds, ABS, MBS, so this investment we can call, or else will prepare your accounting entry for investment purpose. That is investment in securities account debit to cash and bank account. Correct? Because fund is going to invest, so it means fund will purchase something. Exactly. All investment, or I would say investment in securities account debit to cash, and all dividend, coupon, interest payment, that is a part of income. And if you say income, what activity actually happened? There would be 2 to 3 cases which we actually do the accounting. When we say income, there would be 3 scenarios. One, that the income directly will receive to you, and that is like cash based accounting. Cash based accounting. Another would be that is income received in advance, but that is hardly happened. So nobody processes the income that is in advance. Yes, and another would be accrual base. The income, so it means your coupon, maybe dividend, maybe interest payment, that you are accruing, or that is accrued. So you need to prepare the accounting entries in all 3 cases: cash, outstanding income, and accrued income. Yeah, accrual based accounting is valid so that we can refer or do the accounting everywhere. Almost across globe we have a accrual based accounting system, and that's the reason we calculate accruals. And we have a rule for accrual calculation, which is actual days, 360 days or 365, depends, but most of the institutions they refer 360. Anyways, so this is how, see, now you can put your logic. Now here you can put your logic how we can apply the accounting treatment. If you go ahead with the, or if we look to the fund accounting cycle or fund life cycle, so what we are doing, we are signing the documents, we are preparing a pack, we are submitting the document to the respective authorities, and finally we are getting license. And once you get the license, then you can activate the accounts. To activate the broker account, custodian account, to maybe the derivatives account, commodity account, FX, currency, for all financial instruments, you can activate the account. Even you can open the fund bank account, corporate account, where the investors can send the fund. Right? And one more important is some or most of the people what they think, so we can actually means access the bank account or any other that the demat account and all, and we can modify some changes in that account, and that's what we are doing the accounting. No, that is not true. We refer the custodian statement, we refer the bank statements which the fund received cash from XYZ counterparts, or maybe from investors, or maybe fund paid something to the investors to or any other counterparts. So actually here we refer the bank statement. We refer the bank statement. We refer the investment statements, maybe demat account statement, trading account statement, derivative account statement, maybe options and different and so and so. We refer the statements, we try to match that with the system, and if it is not matched, then we can escalate to the broker, maybe custodians or different counterparts, try to get the confirmation, and then you can amend your system. That's how we manage the business. Okay. Anyways, I'll take you ahead. To raise the capital, it means how you can apply the accounting treatment to raise the capital part. Any guess that you would like to put here? Cash to capital. So just add one thing to cash and bank account, debit to share capital account. Okay. Then what about when you invest? Let's say you assume that you are a fund manager. Right? You are the fund manager. What about when you invest that money in the different financial instrument? In that case, what would be the accounting entry? Simple, make it simple. Investment in securities account, debit to cash and bank account. Correct? Okay. So what if you received dividend on your investment, then in that case, what would be the accounting entry, or that, or how you can prepare the accounting entry in that case then? Okay. Subscription, it's a part of liability, right? That you can record to the liability. Investment, when you made investment, that is a part of assets. Okay. To generate returns, it means you have received something. There will be three cases. One, you will receive extra payment for a next accounting period, so that you can treat as an income received in advance. Another case, directly you will receive cash, no advance, no accrued, right? And third case would be accrual. But yeah, so the two cases which hardly happen or rarely happen in this business, but the third case, which is accrual, that happened every time, and that's what we apply the accrual based accounting treatment. Okay, let's assume you have received dividend. That is a part of P&L or income statement. Okay, but dividend is a part of income. Okay. This applies to same to the interest payment as well as to the capital gain as well. What about fees? Expense. Again, you can see three cases with the fees part also. That you can pay the entire fees on time to time, so that would be your cash based accounting. Another would be prepaid. So you can pay the fees to the next accounting period. That process you can call prepaid. Prepaid, right? But yeah, that is also that you can consider like cash based accounting. So you have received cash, so that you need to record it. So it means eventually we have two accounting methods. One is cash and another one is accrued. Okay. And then accrued expenses. Accrual. The expenses which has been accrued but that yet to pay or process the payment to the respective counterparts. And that happened with the expense. Expense again, that is a part of P&L. And also in case of prepaid and accrued, that you can record, those are like adjustment entries, right? So you can record P&L as well as balance sheet. So accrued expense, that you can consider your liability. Prepaid, that you can consider as a current asset. You may expect questions on this part as well. See, we are actually discussing in details about the accounting part, okay? Liability, right? And all the fees that comes under this category: admin, miscellaneous, custodian, broker, agent. Meeting, partnership, and so on and so forth. Okay, then what about to return of capital? So want to return the capital to the investor back. Then what would be the accounting entry then? Share capital account debit to cash and bank, or cash or bank. Okay, then here what happened actually? Cash will be out. So it means actually you are paying the liability. So here two impact you can see, but that would be on an asset side only. Sorry, a balance sheet. That the impacts will be on a balance sheet. So you can reduce, means the asset will be reduced as well as liability also will be. That you can, means you can actually pay the liabilities from the cash. If the asset is 100 and let's say liability is also 100, so you can pay the assets, sorry, liabilities from the assets. So here there would be 0 and this would be also 0. And then finally you can close out your business activities. So if you want to have a good hands on this part, then you should do the practice. Okay, I'll take you ahead with the again technical terms of a private equity business. Now we know the structure, right? Now we know the structure, how it's work. Even though now we are aware about how the private equity investment happened, the most of the fund they invest into in an illiquid assets. Illiquid, it means where you cannot easily get the buyer and seller of your securities. So you cannot liquidate that security easily. Definitely it will liquidate, but not easily. That assets we call an illiquid asset. Illiquid asset. Okay. So we'll see the terms, or instead that I'll walk you through the example. Let's assume, so you are a fund manager, and now as per the structure that we have discussed, you have decided to launch your own fund, which is private equity fund. Okay, try to understand this. All the terms will be linked with this example only. Yeah. That's not the case. We'll discuss that, don't worry, don't be confused about it. Accrual means it means we haven't received cash aid. Cash is yet to receive, or cash will receive. That yet to receive or will receive. That is that we can treat as accrual based accounting. Accrual based accounting. Accrual based accounting. Cash, it means which you have paid it or received it. That you can treat as a cash based accounting. Okay. Anyways, let's say the fund name is XYZ and A, B, C, D, E, F. Those are the investors. They have committed to you, which is 1,000 each, that they are ready to invest in your fund. They are ready to invest. Try to understand this. They are ready to invest 1,000 each in your fund, but not in a one go. Fund will be invested in stages 1, 2, 3, 4, 5, 6, 7, it depends. But here, let's assume that in a 4 stages, the investors will invest or deploy the funds in or transfer the amount to your business or to the fund. Even the fund is also business. If you sign this limited liability partnership agreement, LPA, limited liability partnership agreement, and if they mention that they are ready to transfer you 1,000 rupees to the LLP as a capital, but that is in a stages, different stages, 1, 2, 3, 4. See, this amount you can call the global commitment amount or committed capital. Global, it means for all investors. All investors they have committed, which is they will contribute 1,000 each. So it goes around 6,000 crore or 6,000 rupees as a total capital. That would be that you can say total capital, maybe total commitment, maybe global commitment. If you see the question on global commitment, so you should always narrate an example and give it to the panel. This is not the theoretical aspect which you can discuss, right? You can then narrate, write it down on a paper. Let's say A, B, C, D, those are the investors, and if they commit with this and this amount, so it means this amount you can call global commitment. Okay, let's say today that we have received the first commitment. Today we have received first commitment. And if you are a private equity fund accountant, right? Let's say, see, before receive this amount, there would be process which you can issue the commitment call. Commitment call. What is that, sir? Commitment call. Commitment in a private equity business, whenever you see the word which is commitment, it means it's a capital. Commitment means it's capital. Any doubt on this part? Whenever you see the word which is commitment, it means it's your capital. So before this you can see, or behind this scene you can see the framework, which is you need to draft a mail or later. So what about later? We'll see that. I have to open one. If I had handy, then I'll show you. This later, capital call, and even though this later we can refer for distribution as well. Distribution, it means redemption, and capital call, it means subscription. Simple, make it simple so you can relate with the subscription and redemption. In a private equity business, we cannot say that the subscription and redemptions, we can say capital call and distribution notice. So you need to draft this letter to the investor with stating that, let's say investment fund LLP. This is the LLP, means you're working with the fund. LLP is calling the amount, whatever it is, 1 million, 2 million, 3 million, crore, CR. But in a MNC culture, we cannot use the word like crore, so we can say million, 100 million, 200 million, 300 million, whatsoever it is, as net contribution for an investment management fees and expense offset by cash distribution. So you can distribute. So distribution, it means redemptions. At the time of redemptions, you can offset the fees and all. But even though it's not a mandate one, apart from that, you can invite or you can ask investors to pay the management fees as well along with the contribution. In a private equity business, you can charge the fees in two different ways. One, which is on the basis of net asset value, and another one is on the basis of commitment. It means on the basis of capital which you have received from an investor. Any doubts so far? There will be so many doubts. Yeah, so it means as an accountant, you need to draft this mail. You will do this. When you join any company, you will do this. See the details, right? Your portion of the call is 175000. After this notice, you will have contributed 40% of your commitment off. So it means 50000. This amount was committed by the investors, and your unfunded commitment will be 30000. What is that? Unfunded, it means this amount will be remained with the investors. So in this case, if you take the example, 1000 was the total committed amount, and let's say today that after sent call and all, call letter and all, so we have received 250 rupees from the A, B, C, D and E, F investors. So it means 250 would be your funded amount, and rest 750 would be the unfunded. On unfunded, you cannot charge any fees. Let's say that if we can take the example of credit card. Let's say credit card has a limit of 1 lakh and you have utilized around 25,000 for this month. Then that we know the process. Credit card company will charge the fees on 25,000 only, not the 1 lakh. So interest payment will be charged on 25,000, and rest fees that definitely they will have some mandate charges which they can charge on the 1 lakh also. Okay. The funded and unfunded, which is a very important one while calculating the management fees as well as interest payment also. Any doubt on funded and unfunded? Again, that is the important one. See, whenever I say important one, you may expect questions on terms. Yes, funded, it means always while answering you should give it an example. This is the best way to express or demonstrate. Let's say you can create example like For example, let's say total committed amount is around 1000 and now investor process 250 or 250 rupees. So it means 250 would be the funded one and rest 750 would be the unfunded one. Okay, I'll take you ahead. So here, so it means even though you can see the bank details and all. See this. Date, due date, bank name, bank contact, bank address, CBA, credit note, everything that you need to highlight because eventually payment will receive to the bank account, to the fund bank account. See this, credit to investment fund LLP, account number. So this account you will receive the funds, and once you receive the fund, the Asian bank will send the notification to you that the XYZ investor make the payment to you. So that you can start the accounting from your end. So that you have received in cash as a capital to the business. So that cash can be invested in a variety of different assets, maybe new or maybe existing one. See this, they have mentioned everything. The fund is calling 75000 for an investment in ABC company. ABC is a manufacturer, will get an Accrual OU and will use the capital to expand into the Canadian market. The deal is expected to be closed on and is expected to consist of a total financing of this and this with 15 million something. Coming from the Bank of OU in the form of senior secured note, and the note it means bonds, and the remaining with this coming from an investment partner, Midwest Fund. So both companies can come together and provide fund to the business also. All these details should be highlighted, should be mentioned, should be recorded, dropped to the investor. Are you getting me? And so that later you can call commitment call or capital call letter. That later you can call commitment call letter or capital call letter. And in short, if someone asks what is capital call or commitment call, so it means you can say if you are requesting capital from the investor, that notice you can call commitment call letter or capital call letter. Any doubt so far? As a fund accountant, you will generate this. Why? See, you will receive the data. You will receive the data from the maybe investor allocation team or maybe the investor relation team, fund managers teams. But you need to do this. Under fund accounting, there will be a number of different processes. Might be, let's say you are the part of this process, and you will have to do this. Right? Where under private equity, you can see other a number of processes, maybe casting, recon, trade processing, that is trade settlement, maybe the accrual calculation, accounting entries, and number of things. NAV calculation, pricing team, valuation team. Let's say unfortunately you are part of that team, then you need to do this. Okay. And the rest, and what happened then? So once, so in a step by step that you can, as a fund manager, you can raise the fund and you can deploy that fund into the variety of different assets or in a different businesses as well. Let's assume that you have invested the amount in IRCTC, Zomato, Byju's and PW, means Physics Wala, so one of the latest, the new unicorn I would say, or startup. Right? So what happened actually here, so that the fund, once you raise the funds, that you can deploy or invest funds into variety of different businesses. See, when can take the exit private equity investors from the investment? Once the security will be listed on stock exchange, or maybe before that, if the company has any plan to return the capital of investors. Simple. But we have seen in a Paytm case, Zomato case, IRCTC, they have listed and they have raised the funds, so it means they have raised the funds for an development as well as they have raised the fund to repayment of private equity investment also. At the time of listing, mutual fund and hedge funds will be entered and private equity investors will take the exit. So you can invest and you can, after investment, you can generate the returns as well. You can invest and you can generate the returns. See, there are two types. Let's say you have raised the funds, entire funds on the same day. So same day you have sent the notice to the investors and you have raised the fund, which is 1000 crore or maybe 1000. Let's take the amount, that's fine. You have allocated the funds or invested IRCTC 2000, maybe Zomato 2000, Byju's 1000 and Physics Wala 1000. So total 6000 that you have raised, which is this, and you have invested that funds, all funds into different companies. See, when you received fund, then you need to commit to the investors that you're going to offer the preferred return, which can be up to 8% or more than that. Then there will be types. One, so else the first case which you can offer the preferred return, or else in other case that you can offer the internal rate of return directly. So whatever the returns will be generated, that you can distribute without having any other process. So once, let's say in the first case, if you see that 2000 that you have invested and the current market value which seems around 4000. Yeah. So here you can say the 100% return would be correct. Investor value is 2000 and the returns, yes, 4000. So it means 2000 extra that you will receive to you. That all returns that you can process to the investors, that is like internal rate of return. But most of the investors go ahead with the preferred return. Preferred, it means committed returns which they can commit to you. The returns which they can commit to you. Even though in that you can see two terms which is simple and compounding. See, on a 1500 or maybe on this 8%, if we charge on a 6000, it goes around 480 crore or 480 rupees, let's assume 480 rupees for per year. So it means, let's say if I've raised the funds for the next 5 years, so every years that you can charge the 480. Simple. That is your simple method. And compounding, it means every year. So let's say first year only that the return will be generated, which is 480. But next year that you can add the capital plus preferred return. So you can calculate the 8% on this amount. Which is, see the difference, here 480, here 580. Third year, now you can, yes, add this one and this amount, because this is your preferred return plus principal plus preferred return, and then third year the amount will be around, see this, the difference is 518, 559, and this is how your interest will be, or the return will be compounded. So definitely you may expect questions on these two terms, maybe simple or compounding, or what are the different types to offer the preferred return, simple and compounding, and calculation for compounding. Okay, I'll take you a simple means every year that 480, yes, standard rate, exactly, standard rate will apply 480, 480, 480. Yes. Simple 8% amount into 8 divided by 100. That will be for per year. Yes, principal plus accrued, that the accrued you can say that will be added after that, on which you can again calculate 8%. And even though you can see the terms which is like quarterly compounding, then every quarter the interest rate will be compounded. Maybe semi-annually, maybe annually. Depends on that term. Okay, so try to note down all the important terms, okay? Let's say, IRCTC business, when you had invested, now IRCTC it's time. Or IRCTC now is going to be list, or they have listed. So it means they have sent or processed the fund to us. How much fund that we have received now? Let's say 4,000 crore. Let's assume that the fund we have received, which is within a 1 year of time span. 1 year preferred return, which goes around 16 rupees or 16, let's say we'll calculate this on 2000 because we have only invested 2000. So 160 crore or 160, whatever it is, just check it, that's fine. So it means if we receive this 4,000, then as per the agreement or as per the process, we need to return the principal amount first. Yes, and then after you need to return the 160 rupees, that is the, yes, simple interest, that is accrued or preferred return hours, that we need to process first, then we'll process it. Let's assume it we are paying now, and we'll process this. How much is the remaining amount? 2000, right? 2000 remaining would be in the books of fund. Then you need to pay preference returns which you had committed to the investors at the time of initiation or inception of the scheme, correct? Then pay it. So that is 160. So it means you can pay the 160 from the remaining balance. What would be the amount then? 1840. That would be the remaining amount. So till here you have returned the principal, right? Net process, return the principal to the investor, and even though you have returned the preference return also. But after return, you can see the remaining amount in the books of account, which is around 1840. So on that amount, you need to calculate which is first catch up, 20%. In a hedge fund, we offer the incentive fees to the private equity investors, correct? Once the fund reaches to the committed return or level, then the investors offer the incentive fees or performance fees to the fund manager. But in this private equity business, fund managers will charge the catch-up, which is equivalent to the incentive fees. Catch-up will charge on the return which they have received. Because see, we have returned the capital to the investor, we have returned the preferred return to the investor, but still if you see the remaining amount in the books of fund, then you can charge the catch-up. You may expect question like, is the 20% fixed? No. You may see the higher than that or maybe less than that. But just for an example, we took this 20%. So 20% would be 368. 368 rupees will be transferred to the fund managers as a catch-up or as an incentive fees, or which is equivalent to the incentive fees. But after that also remaining balance that you can see how much. That remaining amount you can split between general partners and limited partners. That split you can divide between general partners and limited partners. That term we can call carried interest. What we can call? Carried interest. So why carried interest? Because fund managers are interested in a last leg of a fund. Because after that you can see there is no calculation required, because here the amount will be zero. See this 174. So after that there will be zero amount in the funds, right? So rest amount which is 147, that you can split 20% to the general partners. When we say general partner, it means your fund managers. When we say limited partners, it means your investors. So that amount you can split. So here the two important terms are very important. The waterfall model. This is a deal by deal basis. Yes, deal by deal basis model, and this is an American model actually. This is an American model. After every deal you can initiate the payment. So here you may expect few questions on a catch-up. What is catch-up? Always you need to ensure that you are writing that on a paper. Prepare one example exactly. If someone asks, don't go ahead with the theories. It will create lots of confusion. Then you cannot answer properly. Trust me, you cannot. Even though I cannot, and that's the reason I follow the standard process, which is I actually create in one example, and throughout the interview process I refer the same example. Maybe for a preferred return, simple compounding, return of capital, right? Redemptions, distributions, for everything, even though for preparation of accounting entries, I refer the same example. For waterfall models as well. So you may expect two questions here on waterfall model. What is the difference between American waterfall model and European waterfall model? Maybe what is a deal by deal model, or what is whole deal model? Whole deal, it means you need to return, yes, 6,000 plus whatever the preferred return would be on the basis of simple or compounding. You need to repay that first, and then after you can initiate your catch up, and then after carried interest. So it means you need to wait till you receive the entire amount of all the companies, or after return of capital and preferred return to the investor, then you can actually, as a fund manager, then you can initiate your catch up, first catch up, second catch up, and then carried interest. That is the difference. Okay. Any questions so far? Any doubt? We have covered the American model. We have, and see the European, it means it's just opposite. First of all, you need to return the entire capital, so which is 6,000 plus accrued or preferred return. Then after only you can calculate the catch up and preferred return. The carried interest. See for that particular deal only you can initiate, right? So for that 2000 rupees you can initiate this. With the Zomato, let's say Zomato also listed, and let's say in a Zomato that you have received loss, so you can only return that 1000 crore to the investor. Then the rest process you don't need to follow anything, right? So you can only, and let's say in a Byju's you have received 5000, so it means you have received 4000 extra. Then you can, then here with this deal, from this deal you can initiate again your catch up and all. Catch up and then carry. Right, here with this deal you can return the principal, means entire principal will be paid, and then the even the preferred return, and the rest amount you can start to calculate your catch up and carried interest. That is the difference. Okay. Okay, so terms like funded, unfunded we have seen. So what about commitment call and capital call? Even we have discussed about it, so you may expect question, right? Even I'll schedule a mock interview for you, so we'll ask questions on all the areas. Then what about pay down? Pay down in short, to return the capital. So that term you can call pay down. See, in a private equity you can see this as a fancy words, but the meaning of the words is like very common, that is pay down. It means to return the capital, so on which or after that you don't need to bear any interest payment. So what is drawn down? Drawn, it means again capital. Down, it means you have received it. In this case, let's say you have received 1000 crore, so every step that you can say drawn down. Drawn down. Okay. So what is principal reductions? Principal reduction, it means, let's say you have sometime that happened with the investment. Let's say you had made the investment in IRCTC, which is 2000, or maybe in a Zomato, let's say you had made investment which is around 2000, but later on you just got the news that the Zomato is not the right one for investment, so you can reduce the principal from this deal by 1000. Means after that only 1 crore 1000 will be with the Zomato, so that the 1000 means that the reduction amount that you can call principal reduction, and that amount you can invest in any other businesses, or as well as you can return it. Anyways, it's a liability, so you need to pay it or return it. See, to understand this private equity business, always you should consider yourself as a fund manager. This is a very important one, and think from that aspect what you are going to do with this, all the activities, how you are raising the capital, how you can apply the accounting treatment, how you can initiate, how you can reduce, unfund, fund, blah blah blah, other different activities. On always, all the time, you should consider yourself as again fund manager, and on behalf of fund manager, let's assume it, yes, I'm doing an accounting for this particular transaction. Clawback we'll discuss later, or else even we can cover it right away. It's very simple. Let's say if you see in a Zomato, we have a received loss, right? Because let's say the 2000 was the original amount, which, or let's say which is, yeah, the invested amount, but we have received only 1000, right? So investors, they are in a loss. Let's assume it, we haven't invested amount here, only we have committed to the Byju's and PW, but now we have received only 1000 from the Zomato which has been listed. But here in this case, the investors, they are in loss. So they may ask you to pay the amount, some amount from the carried interest which you have received, which is 294.4. If they ask you to pay this, that situation you can call clawback. Any doubt? If they ask you to pay as a fund manager, if they ask you to say, let's say I'm investor and you're a fund manager, if I ask you to pay my loss, but that, yeah, so nobody can recover or pay the 100% loss. There would be limit up to that, maybe for a tax liabilities purpose or maybe for any other liabilities purpose. They may ask you to pay from your pocket or the contribution which you have received. That amount or that situation you can call clawback. So in this case also, if someone asks, then you need to write an example. Okay. Then what about dry powder? Let's say investor funded the amount to you, but you don't have any plan for investment. That amount you can treat as a dry powder. Dry powder, the fund which is parked freely in the bank account, or you don't have any plan for investment, that amount you can call dry powder. Dry powder. Any doubts so far? See, in a business there is nothing is fixed. That is like depends on the agreement. Depends on the LP agreement. You can see the different structure for different investors. Okay. I just want to remove all the just hold for a moment. Okay, so anyways, I'm done with the all technical terms. So now it's your time to raise your questions or highlight me if any. Because all the important areas which already I have highlighted to you. Yes, yes. This is the language, okay? So even you can see on a paper. See this unfunded amount, commitment amount. So what is that? That's a language. Contribution, distribution, and the most importantly, even though expenses, fixed expenses, which you can see, I have a list of expenses. Return of capital, return of capital, partnership expense, management fees, tax withholds or withheld, subsequent close interest, excess capital, capital stock, return of capital, partnership expense, management cash, stock, cash, unrealized gain, realized income, clawback, working capital, subsequent close interest, placement agent, partnership expense, other travel and entertainment, organization cost, legal, due diligence, custody, bank fees, audit and tax, preparatory accounting, admin. See this. These are the fixed expenditures. We would be at a call side, it means at the time of commitment call, so that you can highlight, and we will be at a distribution side. Here you can see the categorization as well. See this distribution. Fees and cost paid to the general partners, manager, related third party or outside parties for fundraising services. Interest due from limited partners that committed to subsequent closing of funds. Draw down against unfunded obligation when the final use of funds has not been determined. See this language. This is the language that we follow or use in a private equity business. Okay. We'll see you next session with the accounting entries part. And we'll see what would be the all possible accounting entries. Right. And most importantly, we refer such a templates. ILP templates, limited partnership agreement templates for call and distribution. See this fund name, issue date, due date, fund local currency, USD, general partners commitment, fund size, cumulative fund amount, current notice, cumulative fund amount. Here you can see the section B, limited information, fund local currency, enter all values as positive amount, limited partners, ID, LP commitments, LP percentage of funds, LP commitment and fund size, cap account, NAV percentage, unfunded commitment, cumulative contribution, cumulative distribution, and we record all the data in this way. Aggregate calls, distribution. See this contribution, it means we have received. Distribution, it means we have paid to the investors. Holding name, why you are calling the investment. Section C, call for investment in XYZ company, call investment, transaction type. Here you can see the drop downs, different drop downs, investment expense, partnership expense. So you can select that and accordingly you can record it. Limited partners, impact on unfunded commitment, increase, decrease, depends. Increase, decrease, no funded or no impact. In this way, you can record all your business. Right, so let me stop this.